asset planning as a process is you've got to define what it is you're trying to achieve. And of course, you're trying to set up commercial structures that are going to protect you from your creditors, that deal with your estate and give you the most tax efficient outcome. And when you talk to an accountant about this and you say, well, how should I set up my affairs? Astonishingly, the average accountant is going to focus on their profession, on their background, which is the most tax efficient outcome. So if you ask them about trusts and asset protection, they quite often have a different view of that. They see it as expensive, or they see it as an unnecessary layer of complexity, and they don't necessarily try very hard because it's not their background. They don't have legal concepts in their training. It's all about tax for them. So they'll often be apathetic about asset protection. They'll talk about it, but they won't try very hard to nail that stuff down and get it right. Or they'll stay very narrow in their focus. So rather than trying to look at things holistically to get the best rounded structure to tick all the boxes for the lawyer and the accountant, they'll perhaps put your home in a trust, but they won't dig into some of the more complex asset protection issues because they are legally based, and you have to have a bit of legal training to do that. So really the ideal thing that an accountant would do if they're setting up your structures is connect with your lawyer and ask the lawyer to deal with the issues. But lawyers are busy and often don't collaborate that well with accountants, so that can be quite challenging. So conversely, if you go and ask your lawyers what's the best way to set your tax structures up or your legal structures up, they fall to their training, which will often be very good asset protection, very focused estate planning. They'll do a great job of that. And they often don't have a clue about tax, so they ignore the tax side of the equation and the structures. And lawyers will generally know enough about tax to be very cautious about it. So they will tend to not touch things that they know can be litigious or problematic. For example, if you move property, you can trigger disposals for tax purposes, which mean you have to pay tax on any deemed gains on the residential properties, for example, under bright line rules. They know about that stuff, so they won't tend to want to move rental properties. They know that the better ones know that if you shift shares in companies, that you can forfeit the tax losses if you're not careful, or forfeit all of the tax credits paid in the company, all of the imputation credits. So if you lose the losses or you lose the imputation credits, it's a disaster. So lawyers know that stuff, and they tend to stay away from, digging too deep into restructuring clients' affairs because they can create liability to their client and to themselves. So you get caught in this quagmire where accountants are very specialised, lawyers are very specialised, and as a result, you don't get a great holistic bit of advice that ticks all the boxes. So an asset planner knows both sides of the fence and gives you ideally structures where the lawyer and accountant fit together and it's all working properly. Now, many of you will be my old clients and will have heard me say this in years gone by. 20 years ago, I was on stages telling people about this stuff. But the tax has changed and the structures have changed. So really everything has changed. So this is an update of this very old process that we run at GRA. So we're looking at asset protection first, and the first step of asset protection is, we say, planning for failure. Or another way of looking at it in an asset planner's world, the first step of planning for success is actually planning for failure. What would you do if you knew that you were going to go bankrupt next year? And connect with me here, think about your own affairs. How could, in your own affairs, you be sued? Could it be that you have half a glass of wine too much and drive your car down the road, don't realise you're over the limit, crash into a new Bugatti Veyron or something expensive, new Lamborghini, or some fibre optic tower, and you knock out fibre for the area, you're over the limit, so you don't get insurance. Suddenly you've got personal liability. Maybe you're in Australia and you do that, even worse. You get much larger penalties in Australia. And the thing about the drink driving example is there's no insurance. So, could it be that one of your staff members do it and you have vicarious liability for the actions of your agent or employees? Could it be that your business just harms a third party, and as a result of your property development company or your construction business or engineering business or whatever it is you do, that you harm a third party and the liability exceeds your insurance and you get sued personally as a director? What I want you to think about is, if you knew you were going to go bankrupt next year because some disaster had happened, what would you do today? Because that's the bar you should use when you're setting up your asset protection structures. And the answer to that question would be, you would do everything you can to protect your family from that liability that you know is going to come next year. So with that mindset, you approach things in a wholly different manner. You are very professional about asset protection and you try as hard as you can to protect yourself. And that's our standard when we're setting up asset protection for our clients. So practical things, you might, for example, try and quarantine the problem to a single company so that that single company has the problem and it goes into liquidation and the rest of your affairs are not affected. You might move unrelated assets into other companies or up into a trust. You might think about the money that you've got in the business that you might be running that's caused the liability, if it is a business, and think about making sure that if that money is in harm's way, that you have securities over it so that you're first to be paid ahead of other creditors. And then the person that's suing you ranks behind you for your own money that you've put into the company. So these are the sorts of processes that a good asset protection person will have for you. So let's look at a failed asset protection structure here. So here's you and your spouse. So let's say that you've been advised to own everything jointly. And it's astonishing to us that we still meet clients that do this. They don't use companies and trusts. They have everything in their joint names. So if you have joint ownership of an asset and you trade, that is a deemed partnership under the Partnership Act. And the thing about the Partnership Act is it gives you joint and several liability with the two partners. So that means each of you are 100% liable for any liability that arises. So in this circumstance, there's a property development going and a business going. If either of them cause a disaster, that disaster flows through to you and your spouse. You have joint and several liability, so both of you cop it, and all of the assets get dragged into the disaster. You have to sell everything to satisfy the creditors. So, 101 of asset protection, never trade as a partnership. They are a disaster from an asset protection perspective. They can be quite useful for tax, but don't listen to the accountants if they're telling you to run partnerships. It's very bad from an asset protection perspective. There are better ways to achieve what the accountant needs and to give you asset protection. So a fundamental of asset protection is, if you own it, it can be taken off you. Whether the liability is against you personally because it's something you've done, or whether it is liability arising through your directorship of a company, and so you're being sued as the director of an insolvent company, the liability tends to track to the directors or to individuals. So one of the best ways you can get around the liability attaching to your assets is don't own the assets, put them in trusts. So in this example here, we've got a separate family trust for the home, and we've got separate companies for the various activities. We have a property development company, and indeed we'll have a separate property development company for each property development, so that if one of the developments fail, it doesn't automatically create the other developments to fail because you've quarantined it to a separate company. We've got separate companies for the rental properties, separate companies for the businesses. So to give context to this, this might be a property developer, and business one could be an earthworks business, and it's working for the property development company. If that earthworks business causes harm or liability to somebody and gets sued, that company might liquidate, but the property development company would not automatically get taken down, and vice versa. So you're quarantining disasters from the other companies, and it doesn't automatically contaminate and go across the rest of the group. But it's not just as simple as putting companies in place and putting them in trusts like this. You also have to think about how the liability can flow through the companies up into the trust, or what the trustees' liabilities are, full stop, because often those liabilities can come from the trust and go down into the group, and then you lose everything in the group. So think about how liability gets into the trust. And of course, the first thing that springs to mind is guarantees from a banker. If you are providing guarantees from the trust in relation to the company's activities or other group members' activities, those guarantees mean that the trust assets are automatically available to satisfy any problems that flow out of the companies that are trading. So banks are normally the parties who get into trusts. Sometimes more sophisticated creditors will ask for trust guarantees. So let's go back to that prior slide. If that development company has banking in it and the banker who lends the development company takes the guarantee of the business trust, then that banker gets rental company one, business company one, the whole group. But if that development company, when it's borrowing money, says that you can't have the shareholder guarantee, you can only have the director's guarantee, then you've quarantined the banker to the company alone. Now that might sound too good to be true, but that's exactly what you do. And if the bank is demanding the shareholder's guarantee, form a new trust and migrate the company off into a separate trust so that the shareholder guarantee isn't worth anything. This is how you've got to think if you're going to defend yourself from an asset protection perspective. And remember, the bar is you're going bankrupt next year. What would you do this year if you knew next year it was all going to come to an end? This is the sort of thinking that you do. Because you'd never give them your family trust guarantee. They'll ask for it, don't give it to them. And while we're here, they're most likely going to ask for your spouse's guarantee, and just say no. If you don't ask, you don't get. They'll always ask. But my wife has never guaranteed my banker's obligations, despite the extensive banking that I do through my property activities and various business activities. So just say no. A spouse guarantee is not available. And if they push it, you say, "Oh, why do you want my wife's guarantee or my husband's guarantee? Is it because if I fail as a business, you want to bankrupt my wife who's got nothing to do with it? That's not very nice, is it?" So you just push back on moral grounds, and they, I've never had a bank push back on me on that. So control guarantees. Don't give the shareholder guarantees as a right to the banks. They're going to ask. They're going to create a term sheet. They want this, they want that. Cross it out. Say, we'll give you this, but you can't have that. You've got to control those term sheets that are issued by the bank. So another thing to think about in terms of how liability gets up into the trusts is representations that the trust makes. So for example, if you have a trust that is selling shares in one of your companies, that trust is at risk of misrepresentation claims. I've got a diagram of that coming up for you, but I have seen clients that have sold large companies and their trusts have got sued because the companies have failed after they've sold them. So I'll show you that with a diagram in a moment. But let's start with bank securities. And what I've shown you this many times if you've been on my workshops. This is split loan structures and avoiding cross securities. So here we have the family trust, and the broker has done the easiest thing they can for themselves and the banks. They have taken security on the home and lent the money into the rental company and the development company. And that is a terrible banking structure. It's probably the most common banking structure, but it is a terrible banking structure, because if the development company fails or the rental company fails, everything is cross-linked and the bank starts winding everything up and they take everything, and you get the last dollars that are left. So that, that's a terrible structure because you have no control over the banks. Also, if you sell an asset in a down market, and it's quite timely, the market's in recession at the moment. If you sell an asset in a down market, you might want liquidity. So you might sell a couple of rentals to pay some creditors and get you a buffer. Maybe you've lost your job, maybe you've got some issues. If you want that money to get through, you might not get it because the banks tend to take full proceeds if they've got these types of structures where no matter what you sell, they take full proceeds the moment you sell them because they've got these cross securities. So if you have a disaster, it affects everything, they take everything, or more likely and more practically, if you sell something, they're going to take the money. And if you need it, that's not useful. So as an alternative, split loan structures are very powerful structures to break the banks up. So for the development company, if they want 40% equity, you might take the 40% loan against your family home, inject that, and then go to bank B, another bank, and lend the 60% in there. And in the same way with the rental company, you'll pull 40% off bank A and put 60% off a third bank, bank C, and try and break all these banks apart. So when you sell things in your rental company, whatever proceeds you get, there's no cross security, you get full proceeds to take for your affairs. Bank B is the same. If your developments come to a conclusion and cash up, you get all the money back into your development company to pay off bank A or to go again in another development. So breaking the banks apart, splitting the loans up like this, split loan structures, is a very effective way of setting your structures up. Now, we preach this in an up market, and everybody's so hell-bent on buying houses that they ignore us. Their brokers just get them the money and they do whatever they want. Now we're in the down market. People who have done this, cross-secured everything, are going to experience exactly what I'm talking about. The banks will take full proceeds, and if they have a problem, they lose the lot. And also, when you're in this situation, one bank, because they're so big, they're such a large dominating party to your affairs, they start to control you. So they'll say things like, oh, this is a very adverse market. You want to buy another property or you want to start a business. We don't think that's prudent in this environment. So actually, we're not going to give you any more money. And they might even say things like, we want you to start selling because we think you're overexposed. Interest rates have gone up. But if you've got this sort of structure, that doesn't happen. You've broken the banks up and you remain in control. So that is just a vastly superior way to control your banking. So this is asset protection and financing structures. And then just demonstrating that if you did lose a development, Bank C and Bank A aren't necessarily affected. So I mentioned that you've got to look at how liability can get up into your trusts. And one of the ways is bank guarantees of the shareholders. And if the trust is the shareholder, that gets the trust up, the bank up into the trust. Then they get all of the other companies owned by that trust. So I guess the point of that is don't give the banks the guarantee of the shareholders if the shareholder is a trust and owns other assets. Another way you can get into trouble from an asset protection perspective is when you sell the shares of large businesses. So here we're going to sell Big Business Limited. It's a decent sized company. It's got a value of 5 million, and we're going to sell the shares to a purchaser. What else is at risk? You might look at this and think the rental company is not at risk because there's no cross-company liability. If Big Business liquidates, there's no shareholder liability to the trust. So the liability does not flow through to the trust and down to the rental company. So we've quarantined it off, which is good. But think about what happens if Big Business Limited is passed over to the purchaser. They've paid the 5 million to Trust 1, and then it turns out that there's a problem in Big Business Limited. It doesn't perform as projected. The purchaser is going to be angry, and they typically look to the vendor of the shares and say, you sold us something that wasn't what you said it was. That's misrepresentation. So they sue the vendor of the shares. It's very common. They sue the accountants, they sue the lawyers, they sue the real estate agent who was involved in selling the shares. They sue everybody, but they sue the trust that sold the shares. So suddenly that problem that is the purchaser's problem in big business becomes a trust problem, and the trust owns your rental company. So the better way to deal with this situation is have a separate trust for the rental company and quarantine that transaction to a single trust so that Trust 1 sells to the purchaser and Trust 2 owns the rental company, so that if they do sue Trust 1 after you've settled with them, they can't get at your rental company. So this might seem abstract and it might only affect 1% of you that are out there, but if you are thinking of selling your business, I've seen this in practice, and it is something you should be thinking about.